Tax refunds and bank accounts are a very big deal in bankruptcy. In a Chapter 7 bankruptcy, whatever you own at the time you file belongs to your creditors. Now when you think that through for a minute, a big bell goes off and says, wow, okay, so cash, bank accounts, somebody might owe me money, I got a tax refund coming back. All kinds of things that you don't really think of when you think of your couch and your TV and stuff like that are probably exempt and you're probably not going to lose. But cash, bank accounts, and tax refunds are never exempt in bankruptcy. And they are the backbone of trustees' income. So they're very sensitive about making sure that the rules are followed and that they get as much of those items from you as they can get. So you need an attorney like me who's going to help you keep those items if at all possible. Now the rules are like this in Chapter 7. If you're owed a tax refund at the time you file, then the portion that you are owed belongs to your creditors. And it works like this. There's a formula. If you file bankruptcy in, say, on October 1st, 2011, then all of your tax refund for the 2011 tax year up until October 1st belongs to your creditors. And what you accrue after October 1st belongs to you. And October, November, and December, that's 3 months, that's 1/4 of the year. So if you have a $2,000 tax refund, you get 1/4 and your creditors get 3/4. If you file the case on July 1st, you get half, your creditors get half. Now, when this really becomes crucial is when you file in between, say, September and March or April, because that's when trustees are looking for big tax refunds. If you file in September, they're going to hold your case open until March or April of the next year and take their 3/4 of your tax refund. When you file in March or April, they're going to be expecting to take 100%. And so what a lot of people do is they'll come and see me, we'll talk over their case, we'll figure out when a good time to file is, they'll file their tax return, get the tax refunds back, and then spend the money on their attorney's fees, on a mortgage payment or two, on groceries, on school clothes, on vital, important things that they're not going to be questioned on. And then when we file the case, the money's gone and their trustee doesn't get anything. Bank accounts are the same way. I was in a bankruptcy creditors meeting one day, and the bankruptcy trustee asked for a copy of the debtor's bank account from the date that they filed their bankruptcy, and there was $1,500 in the bank on that date. And the bankruptcy trustee said, all right, write me a check today for $1,500. And this particular bankruptcy debtor didn't have an attorney. He didn't understand that even though payday was the day before he filed, he was going to have to turn over every cent of that, even though it needed to go to his mortgage, to his car payment, to whatever his ordinary monthly expenses, because it was the crucial day he filed that all that money was in the bank, he lost it all. And so you just have to remember that if you're filing Chapter 7, what you own on the day you file is what you're going to lose. And so we generally will try to time the filing so that you're in between paydays, so that you're not filing right after a check gets put in and when you've got too much money in the bank and it's lots of money for you to lose. If you're filing under Chapter 13, these issues are not quite as critical, but they're still important. Because with Chapter 13, you have to pay your unsecured creditors at least the value of what you own on the day you file. And so once again, these issues become important in terms of valuing your assets, but you don't actually lose them. Now in Chapter 13, there is a split of your tax refunds for the first 3 years that you're in your Chapter 13 plan. And this is a Utah rule, so anybody who's looking at this video who's not looking to file a bankruptcy in Utah, this won't have anything to do with you. But here in Utah, the courts have decided that the first $1,000 of any tax refund during Chapter 13, the debtor gets to keep. Then, if you receive either earned income credit or additional child tax credit on your tax refund, then you get to keep another $1,000 or the amount of those credits, whichever is less. And so most debtors with kids get to keep $2,000, and most debtors without kids get to keep $1,000, and the rest gets turned over to your creditors. Now, having a good lawyer means that you have a lawyer who tells you, all right, that's all fine and good. The way we're going to get around that is you're going to change your deductions after we file the case, and you're no longer going to be deducting so much from your check. Your tax refunds aren't going to be as big. You're going to get the money in your checks. You're not going to get big fat tax refunds, and then you're going to get to keep the money and not turn it over to creditors. The important thing is to hire an attorney who knows what they're doing and has the experience to understand the rules thoroughly and to understand the consequences of timing the filing right, whether you're under Chapter 7 or Chapter 13.